NVIDIA alone is now worth more than the entire German stock market. 7 AI-adjacent stocks power over 40% of the S&P 500. Sound familiar? Rewind to 1999. The Nasdaq doubled in 12 months. Companies added .com to their corporate name and watched their share prices triple literally overnight on no actual news. Pets.com raised $82 million, ran a Super Bowl ad with a sock puppet, and vanished 9 months later. The crash that followed erased $5 trillion in market value. Today the parallels are loud. ChatGPT hit 100 million users in 2 months, the fastest consumer product launch in history. Investors poured $500 billion into AI startups. But this time, the believers say it's different. Real revenue, real chips, real productivity gains for actual workers. The skeptics counter that every bubble in history has said exactly that. OpenAI's valuation rocketed from $29 billion to $500 billion in under 3 years. No publicly traded company in the history of capitalism has ever scaled in value that quickly. Anthropic, founded back in 2021, now commands a $180 billion valuation. Mistral, Cohere, Perplexity, xAI, all became unicorns within months of their official launch. Microsoft pledged $80 billion to AI infrastructure this year alone. Google, Meta, and Amazon combined will spend well over $300 billion across 2025. All that capital chases a single bottleneck, NVIDIA's H100 GPUs. Each chip costs roughly $40,000 and ships with a waitlist stretching 18 months out. NVIDIA's market capitalization crossed $4 trillion in 2025. The company's price-to-earnings ratio still trades like a hypergrowth startup, not a mature industrial semiconductor giant. Meanwhile, the actual AI revenue numbers tell a different story. OpenAI is projected to lose roughly $5 billion this year, on $12 billion in revenue. Anthropic is burning through cash even faster than OpenAI. The brutal economics of training frontier models require billions in compute long before a single paying customer ever signs up. Goldman Sachs estimates the AI sector needs at least $1 trillion in annual revenue by 2030, just to justify the current infrastructure spending pace. $1 trillion is roughly the entire combined revenue of Apple, Microsoft, and Google today. From a technology that currently generates under $50 billion in real annual revenue. MIT researchers recently studied 300 AI deployments across enterprise customers. 95% of them failed to deliver any measurable return on the investment companies had made. And yet the spending only accelerates. Data center construction has tripled globally since 2022, now consuming roughly as much electricity as a mid-sized European country. Hyperscalers are now signing 20-year nuclear power purchase agreements. Microsoft helped reopen 3 Mile Island. Amazon bought an entire nuclear-powered campus in rural Pennsylvania. Total energy demand from AI workloads could double by the end of 2026. Some utilities have warned they cannot keep up without freezing new residential connections. Real estate around data centers is now exploding. Northern Virginia, the world's largest data center hub, has officially run out of available power grid capacity. Circular financing has emerged as the elephant in the room. NVIDIA invests cash into OpenAI. OpenAI uses that same cash to buy NVIDIA GPUs. The dollars cycle back to NVIDIA. Microsoft funds OpenAI with cloud credits. OpenAI then pays Microsoft Azure for compute. Azure's reported revenue growth gets booked publicly as proof of organic AI demand. Industry critics now call this entire dynamic the AI Ouroboros, a snake eating its own tail, creating the appearance of explosive growth without bringing in any external paying customers. Cisco Systems played the exact same role back in 1999. It supplied the routers and switches, the picks and shovels of the internet gold rush. Cisco's stock price rose 1,000% in just 5 years. Then it collapsed 86% when telecom orders for routers dried up almost overnight. Today's Cisco is unmistakably NVIDIA. If hyperscaler capital spending pauses for even one single quarter, the entire current valuation thesis suddenly comes under direct attack. Concentration risk is sitting at historic highs. The Magnificent 7 megacap stocks now represent over 30% of the total U.S. equity market value. If you own a plain S&P 500 index fund through your retirement account, you own a heavily leveraged bet on artificial intelligence, whether you actually know it or not. Private market valuations have completely decoupled from any public market comparables. Pre-revenue AI agent startups regularly raise at billion-dollar valuations on a slide deck alone. Y Combinator's most recent batch was 80% AI companies. Solo founders are now raising seed rounds at $50 million valuations before writing even a single line of code. Sequoia Capital itself publicly warned of a $600 billion revenue gap between current AI infrastructure investment and actual customer payments hitting balance sheets. Even AI bulls now quietly admit the gap exists. The only real question is whether revenue catches up over time, or whether the capital runs out first. Historically, every major infrastructure boom overshoots. Railroads, telegraphs, fiber optic cables. The physical build-out was real every time. The investor losses afterward were also painfully real. And then came the warning shot. In January 2025, a small Chinese startup called DeepSeek released a frontier-class model trained for just $6 million. $6 million. Not $6 billion. That's roughly what American AI labs spend in a single weekend of GPU rentals on their dedicated cloud clusters. NVIDIA lost $600 billion in market value in just one single trading session that morning. It was the largest one-day loss in stock market history. The entire thesis suddenly cracked. If frontier AI can really be built for the price of a Manhattan apartment, why does anyone need $1 trillion in data centers? Here's what changed everything. The moat was never actually compute capacity. The real moat was hype itself, and hype evaporates dramatically faster than physical infrastructure depreciates. Open-source models from Meta, Mistral, and Alibaba now match GPT-4 on most public benchmarks at a small fraction of the per-token cost. Inference prices have dropped a stunning 99% in 2 years. The exact same AI query that cost $20 in 2023 now costs about 2 cents. Commoditization is the ultimate bubble killer. When margins collapse to near zero, the optimistic cash flow projections that justify trillion-dollar valuations collapse right alongside them. Goldman Sachs, Apollo Global, and even the Bank of England have now all publicly warned of AI bubble dynamics. The signal is officially no longer a fringe view. But here's the nuance that most headlines completely miss. A bubble in valuations does not necessarily mean the underlying technology itself is fake or worthless. The internet was undeniably real. Amazon survived the dot-com crash, rebuilt itself, and went on to define the next 2 decades of global commerce and computing. AI is also real. Modern models can write code, diagnose disease, translate any language fluently, and accelerate scientific research. The productivity gains are not science fiction. What's bubbly is the price, not the promise. Today's investors are paying for 20 years of projected future profits in advance, on companies still losing billions of dollars yearly. When the correction comes, and economic history strongly suggests it will, the survivors will be companies with real paying customers, not just impressive product demos and viral tweets. 5 to 10 AI firms will eventually become the next Amazon, Google, or Apple. Hundreds more will quietly become the next Pets.com, and disappear from memory. The genuinely hard part for investors is guessing exactly which is which. Even the smartest money on Wall Street got it wildly wrong in 1999. So is this an actual bubble? By every traditional valuation metric, yes. By the standard of genuinely transformative technology, also yes. Both things can absolutely be true at once. Subscribe for more deep dives on the markets shaping the next decade. Drop your bubble verdict down in the comments below.